This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Business Week podcast with Carol Massar and Tim Stenivek from Bloomberg Radio.
All right, well, as we mentioned, today is the day the Federal Reserve kicking off its two-day policy meeting. It's the final one of the year. Tomorrow, we are going to get a rate decision. Of course, we're going to hear from Fed Chair Jay Powell. Pretty much everyone expecting that the Fed's going to hold rates steady for a third consecutive meeting. And why shouldn't they? We've got a bunch of encouraging data for team soft landing over the past 6 weeks or so. Most recently, today's CPI print, which largely came in line with forecasts. We should note that traders did trim their expectations for the Fed to aggressively ease monetary policy next year. Now, Emily, they're seeing about 108 basis points of Fed rate cuts next year, down slightly.
Down about 2 basis points.
So down ever so slightly before the CPI numbers came out. Hey, we got a great voice with us. Regular viewers and listeners know him well. He joins us regularly when the Fed meets. We got Dr. Stephen Skanke, Chief Economic Advisor at Keel Point. His public service spanning 4 presidential administrations, Nixon, Ford, Carter, and Reagan. He served on the White House National Security Council staff and economic policy team and at the U.S. Treasury. He joins us here in the Bloomberg Interactive Brokers studio. Good to see you. It's rare that we get you in the flesh.
I know. It's great to see you, Tim and Emily, to meet you. We're in New York to do a few things here, some meetings and some shows. So it's great that we can come by and be with you in person.
Yeah, it's really good to have you here with us. How are you looking at the last 6 weeks of data that we've gotten from softer than expected employment reports, or one in particular, to CPI data coming in showing that, hey, the Fed does seem to be having this to a certain extent under control?
Yeah, the data has been actually very good. And when you look at it overall, the economy is in good shape. Employment is cooling, but not too quickly. Consumers have confidence. Spending still is remarkably robust. The PCE core inflation numbers have been great when you look at the 3-month and 6-month annualized numbers. And I think Jay Powell is probably breathing a sigh of relief today with the CPI numbers. There have been some internal discussion about should they start cutting in March. He's been trying to hold off expectations. And so the CPI number being up just a touch over October core CPI is really good news for him. And I think it settles and allows them to maintain their wait and see stance and not to let markets get ahead of themselves.
Tim had mentioned that we saw expectations for a cut ease just a little bit, but I would say largely unchanged when it comes to before and after the CPI print. The market traders are really still expecting that we'll see quite a bit of easing. What do you make of that reaction that we saw to this inflation data?
Well, it was interesting. Last week, Fed Fund Futures had a 60% bet that they'd start cutting in March. And after the CPI print this morning, that went down to about 48% odds. So that it's eased back a little bit, but I think markets are still expecting the Fed to move decisively once we get into 2024. And whether it starts in March or May, which is sort of the current expectation, absent some dynamic move in the numbers this month and next month, I think we're going to see them get started when they get started and go about 25 basis points per meeting. Unless something happens, if we don't have a soft landing, if there's a nosedive, they could amp up the cutting. But otherwise, it looks like the trajectory that we're on, we'll see about 25 basis points a quarter, whether we start in March or in May.
Do you think that's the right move for the Fed to be making, given the history of over the last 40, 50 years, the 2 instances of moving too quickly to cut rates when the Fed thought that inflation had been tamed?
Well, I understand their caution, and this current board or this current chairman got head faked out in 2021 and was too encouraging too soon. So Jay Powell is going to be particularly cautious. But if we see inflation continue, especially core PCE, continue to annualize in the 2.4, 2.5 and move on down, then what we have with interest rates where they are is real active restraint on economic growth, because you've got a positive real rate of interest in the range of 2.25% to 2.5%. And that would really squeeze the economy, particularly as it's slowing. And they certainly don't want us to nosedive into a recession. You know, one of the things we've learned over the years is that GDP growth and unemployment aren't linear. I mean, we saw unemployment go up to 3.9. Now it's come back, which is great. That's as a result of more people coming into the labor force, particularly parents who now have adequate child care. That's great news. But it could turn on a dime, and all of a sudden it's in the 4% range, and a lot of anxiety and decisions that are unhelpful start being made then.
So tomorrow, during the Fed meeting, I will be working on the Top Live blog, where we sit in front of the Bloomberg terminal and we pretty much parse every word that Jay Powell says.
I thought that was all AI. That's real people?
No, it's
I'm
real
just
people.
kidding. I know.
I think the AI helps us make charts. But I'm really curious how you're thinking about how Powell is going to sound tomorrow, because I was reading one note and a strategist had said he doesn't really have any reason to sound more dovish here, especially since we've already seen a loosening in financial conditions. We've already seen rates come down so much. Why would he give the market even more, I guess, excitement about rate cuts? But what do you think we're going to hear from him?
Well, we'll see what the bots say, but I believe that the CPI print today gives him the ability not to be dovish, but not to be too hawkish. Mm-hmm. I think he was coming into the meeting with the PCI or the PCE inflation that we had, and Governor Waller's comments that led markets to think that rate cutting would start in March. And then Jay Powell came out and tried to damp it down, but it didn't really work with markets. So I think he was feeling a little bit of tension to have to come out a little bit strong at his press conference tomorrow. And now with the CPI number that we got and where Fed funds futures are, albeit not greatly moved, mm-hmm. but at least moved in the direction that Powell would like. And so I think it'll be a relaxed and smooth.
Boring.
Let's see where the data takes us.
I told you, Tim. It'll
I
be
know.
boring.
But it can't be boring. We got to be excited about this stuff.
I'll love it.
Dr. Skanke, does anything about this narrative give you pause right now? And I think back to Friday's employment report, and the unemployment rate actually came down. Is it possible to have a soft landing when the U.S. economy continues to add jobs and the unemployment rate continues to go lower? I
think it is, Tim. The opportunity for a soft landing, I think, has actually gotten better. My great concern is that the Fed right now has a particularly restrictive stance on, and with what we've seen in a reduction in money supply, M2, is down now for about 5 quarters. Historically, that didn't bode well for economic growth 18 months out, and we're coming up on 18 months out when we get into March. I think we could have a big surprise. I'd love to have a soft landing. I think there's a great opportunity for it, but I don't think we're going to get it. I still think that we're going to end up in a recession. You do think we are? I do think that we will. I think it'll be shallow. I think it'll be short-lived. But I think that the cumulative effect of what the Fed has been doing over the last year and a half still has a bite in it that we haven't seen fully taken. Just in the last 20 seconds, where do we see that happen? What part of the economy? I think in GDP growth, in the service sector, and in companies tightening up on employment. You think we'll start to see jobs being lost each month? I do. When do you think we'll start to see that? I think it'll probably come in late March, early April. Okay. Well, we'll definitely have to have you back before then. Always good to see you, and really good to see you in person. Dr. Stephen Skanke, he's Chief Economic Advisor at Heel Point, also former White House National Security Council staff and economic policy team member, and at the U.S. Treasury as well. It's Bloomberg Business Week.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
It is a busy week, Emily.
There's a lot going on.
Yeah.
I'm actually more excited now.
You should be. It's a really exciting week. I think you make a really good point earlier about retail sales. That's post Fed, past the Fed. That's what certainly to keep an eye on. Hey, speaking of the economy, different ends of the economy, certainly. A story in the Wall Street Journal a few weeks ago, it really caught my eye. I sent it off to Paul Brennan, our producer. I said, we got to get Citizens Bank, Citizens Financial Group, back on the show because it's all about how Citizens Financial Group has opened a new private bank for wealthy customers. And it's actually taking a page from the book of First Republic Bank. That's right, First Republic Bank. It's the bank that failed back in May, but one that was known for high-end customer service. It was known for those really, really low mortgage rates over the last few years, and that's certainly what got it in trouble. We've got a lot to get to with Brendan Coughlin, Vice Chairman and Head of Consumer Banking at Citizens Financial Group. He joins us here in the Bloomberg Interactive Broker Studio. Brendan, good to have you with us. How are you?
Thanks for having me. I'm doing great. Thanks.
So when I saw that story, I thought this is great because that means we're all going to get low mortgage rates again, just like First Republic did for so long. But that's not necessarily the case with kind of what you guys are doing over at Citizens, right?
Yeah, it's not.
Okay, too bad.
It's too bad. Look,
high mortgage rates are here to stay.
We are on a journey as an organization to really build out a world-class franchise. We went public back in 2014, and we've viewed this as the next natural step.
And what you're doing is you're actually hiring a lot of people who were at First Republic.
We are. We've hired about 200 people so far, and with the bank failures in March, it became very clear to us that while those firms would no longer exist, there was a lot of talent in play, and there was white space open in the private banking sector in the United States for a service-led firm to come in. And so we brought on a lot of folks. We're building a high-end private bank here at Citizens. We've made no secret about it that we aspire to build a great wealth management platform. And what we aspire to do is really take the best of some of the firms that are not around anymore. Your point around the service culture is really distinctive and unique, but we are making business model corrections. We're going to be highly competitive on lending, but we will be market competitive. We will not undercut the market. We're going to have really great credit quality, and we're going to grow at the pace of raising quality deposits. So we build a really durable strategy, but it will be all grounded in high-end, intense service that's uncommon in financial services for that client base.
What do you currently make of the state of the consumer? Because we read a lot about how inflation actually hurts the lower end of the consumer the most, and these higher income individuals are perhaps more shielded from the macro environment and higher inflation. Was that at all part of the decision to cater towards this client?
Well, the economy is not being felt the same way across all demographics. The bottom, 2 or 3 deciles of the economy is back to paycheck. The average consumer is still buoyed by all the COVID stimulus. We still see consumers with 10 to 15% more in their deposit account than prior to COVID, and their underlying delinquency still it's starting to burn
10
down.
to 15% more?
It is, and it's slowly but surely burning down, but spending remains high, but excess deposits are still out there in the banking system, and delinquency rates, while they're almost back to normal, they're still lower. So when I look at the overall health of the economy, and I heard you mention potentially a soft landing, if you make that case, I think you could support it by the health of the consumer really buoying the economy, because they are in a position of real strength, even though the economy's not felt the same all the way through every segment. But it is true that the higher end of the market has significant strength and a lot of resilience right now. And I think with the disruption in the space with First Republic and SVB exiting the market, we do believe there's a lot of white space for innovation and banks to step up and re-provide that service level for really part of the economy that is still very, very strong.
What do you envision being that service level? Because there's no shortage of folks who want to manage money out there. Trust me, we have them on our program every single day. We never run out of them. So like, where are you seeing the white space?
The beauty of the market of the business model is actually quite simple. It's to bigger banks that tend to have great capabilities and very sophisticated capabilities, also are very big and they're siloed. And so the beauty of those models is that it broke down all the silos and you had a single point of contact that really brought the full breadth of the bank, and they valued your full relationship when, if you were doing a multifamily commercial real estate deal, or if you're bringing your wealth management, or you're doing deposit banking, or if you're part of the private equity and venture community, all of those parts of your relationship were integrated together as one, and the appropriate service was delivered back in spades to the client. So that's what we aim to replicate, and we've got tremendous feedback. The clients so far have been saying, hey, look, the brand that we're voting with is the brand of our banker. You now employ our banker. We're all in because we know what that person has been able to deliver.
So those individuals you were hiring from First Republic are actually bringing over clients.
The clients are calling us, and they're saying, we want to recreate that magic that we felt in the service intensity that existed there.
Explain the relationship with JP Morgan and how, can people jump, or they get hired if they didn't get laid off during the acquisition that, JP Morgan took over the assets, of course. Then can they just leave? Like, how does it work?
We're not intentionally calling anybody at JP Morgan, but employees get to choose where they work for every morning, and we're building out a world-class private bank, and we've hired folks from a lot of different places. But where we have open positions and there are folks that want to change brands, we're up for interviewing them, and we're open for business. And in an economy, and banks are obviously playing a lot of defense right now, making sure the deposit book is clean, the commercial real estate business is clean. This is one space where we're playing a lot of offense. We're going to hire, we're trying to reposition the company, and we think there's white space out there. And so some of the best bankers in the United States thus far have voted with their feet and selected a New Jersey.
Is the current regulatory environment helping you guys play offense, or is it a bit of a hurdle?
Yeah, I think the regulatory environment, obviously coming off the heels of a crisis like the bank failures, can tend to react pretty strongly, and that's what I think we're all predicting. And my worry is the unintended consequences and the cumulative impact of the regulatory action. So you've got the Fed taking a lot of money out of the banking system. That triggers banks to be less confident in lending. You've got potential liquidity regulation coming to value deposits in different ways. That potentially triggers less lending. And you have Basel III endgame to make banks hold more capital against particular parts of lending. That triggers less lending. So I am worried about the cumulative impact of this, that banks may be less willing to put more capital in the market, and it could actually be a negative force around a soft landing. So we'll see. Time will tell, but certainly there's a lot of regulatory activity going on now.
Brendan,
transmission mechanism.
Oh, go ahead. Yeah, exactly.
We say that word all the time.
That's your world over and over again, Emily.
Exactly.
Brendan, how do you think about the physical branch in this day and age? I mean, you guys are relatively limited with your geographical footprint because you're only in 11 states right now, but you do have 1,000 branches, so it's a big footprint in 11 states. How are you thinking about changing geographically as you do this?
Yeah, there's been a conversation in the market for 2 decades about the death of the retail branch. And look, if you can get through a global pandemic where people were not willing to leave their house to do much of anything, let alone walk into a branch, and you reemerge an economy that people still value retail banking, I would say the U.S. consumer is voting with their feet that branch banking is still very valued part of how they think about financial services. Now, if you look at Gen Z, they'll tell you they have no interest to go to a bank branch, but they actually won't open an account unless there's a physical location in your MSA. So it's viewed as a safety net, and they don't actually want to go there, but they need the capacity.
Does that mean you're growing beyond the 11 states that you're in right now?
We are. We're a national bank now. We just bought HSBC's U.S. franchise. We bought Investors Bank. That put us in New York City. It put us in northern New Jersey. Put us in Washington, D.C. It put us in southern Florida. So we're now up to about 15 states in retail banking. We're open for business nationally with a national digital bank called Citizens Access. So digital is pervasive through service in retail banking. It's the combination of digital and physical banking that really consumers value.
Well, really cool stuff. Thanks so much for stopping by.
Thanks for having me.
So much has changed in the banking industry in just a few months. I mean, just think, it was this year that we saw the regional bank crisis, and here we are, and close to the end of the year, and so many changes. Brendan Coughlin, Vice Chair and Head of Consumer Banking at Citizens Financial Group, joining us here in the Bloomberg Interactive Brokers studio. You are watching Bloomberg Business Week.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Well, it's already that time. We got just about 18 minutes to go until the close of U.S. trading here in New York City. It's time for a Drive to the Close. For that, we go to Anna Arsov, Global Head of Private Credit and Financial Institutions at Moody's Investor Services. Anna joins us on Zoom from New York City. Anna, good to have you back with us. How are you?
Great. Thank you for having me.
Yeah, thanks so much for joining us. Okay, let's take a step back and just think about, where we were a couple of years ago. Carol likes to talk about that moment that the two of us had at Milken. I believe it was, over 2 years ago, where we left Milken and we said to each other, private credit is kind of all that anybody talked about at that version of the Global Institute, the Institute's global conference. Where are we now 2 years later when it comes to private credit, especially at a time when banks have pulled back a little bit due to high interest rates and consumers have pulled back on spending quite a bit?
Yeah, I mean, these days you cannot turn anywhere, as you said, without talking about private credit. Probably 2 years ago was more the Milken and the special conferences or special, opinion makers like ourselves who were launching at that time. Our first research campaign on private credit was in 2021. And it was very interesting. At that time, it was really folks who were extremely, I would say, in the professional ranks and in the professional, I would say, journalistic and regulatory environment that really cared. It was not like something that was a mass topic of discussion. And then you say, where are we now? 2 years later, you almost cannot turn a news cycle or, particularly in the finance world or a publication, and even talking to any kind of asset manager that does not either increase their private credit or alternatives allocations, or is interested to build one. So it's definitely becoming an asset class du jour.
Anna, does this make sense with the macro environment that we're seeing? I know you have a relatively pessimistic outlook for 2024. So how do you square the boom in private credit with perhaps what's going on and what is going to progress in the macro environment in 2024?
Look, absolutely. You have to kind of think about the forces that are at play here. At the end of the day, private equity has $1 trillion of dry powder that has to be put in play. And we know that typically, private equity puts this dry powder, favorably, of course, in a low rate environment where there is growth or M&A potential. That was not the environment that we had over the last 2 years. We had high rates and we had a lot of uncertainty around monetary policy, political uncertainty, geopolitics, and obviously economic growth slowing down. So from that perspective, this capital obviously is sitting on the sidelines and needs to be deployed. And in terms of how it's deployed, it has to be levered with some kind of financing. And typically, as we know, the Wall Street and the broadly syndicated loan market has been the core of how this market has been, who's financed the financial sponsor universe. So private credit came in this more uncertain times over the last few years with the disruptions in the BSL market, and then came in with a certainty of execution, which was very important. So whoever had to put deal in the market, and particularly if those deals had a little bit of more hair, name it, it's a little bit high leverage, some restructuring, some infusion of capital from a sponsor, the BSL market would not be, was not open really for the low Bs, if you will, from a rating perspective. So they ended up in the private markets, and they ended up for a very rich premium of illiquidity premium of roughly around 200 basis points. So it was a nice boom if you are basically in this market, and there were no real, credit losses over the last 2 years. So, and why was that the case? Because a lot of the portfolio companies refinanced in the 20-21%, low rate environment or zero rate environment. And so they bought some time. And what we've noticed now, as the rates start hiking obviously over the last year, there has been some negative implications on performance that's first seen in interest coverage, not yet in the credit story, but eventually it will show up in the credit story.
Anna, what happens if we actually do achieve a soft landing here? It seems like Team Soft Landing is winning at this point. Equity in the bond market are certainly saying that. If rates come down, if the Fed cuts, do we see private credit suffering as a result of that? Because, customers will start to take loans out from traditional financial institutions?
Look, not necessarily. Private credit will suffer if we have actually continued rate hikes. And what I mean by suffer will, from a credit perspective and performance. Decreasing the rates will improve credit and kind of sustain credit performance. We're certainly going to see, higher defaults in the highly levered customers from where we are now. But that would play much better for a default cycle than significantly higher rates from here. So from credit performance, lower rates are actually better. From a competitive standpoint of view, which is part of your questions, we do expect when there's a little bit more rate certainty for the public markets, the broadly syndicated loan market, to open. We actually wrote a report that we say that, as a matter of fact, with the opening of the BSL market, which we anticipate, and it was kind of a little bit of start and stop in the fall of this year, because we still had a lot of uncertainty from an economic perspective, but we think 2024 is probably going to be better for that market. There will be competition between private credit and the BSL market, but that competition is really going to be in the in that sort of north of $700, $500 million transactions. Private credit has always existed in the middle market space, and that is kind of the sweet spot that the banks are not really going to play. So that's going to continue to be the sweet spot for them. There will be some credit losses higher from here, but if the rate cycle actually is more constructive, that will obviously be better for them. However, on the competitive side, with the BSL market open and the large players who compete with the BSL market, like the Blackstones, like Ares, like Blue Owl, they certainly will find more competition. So maybe this illiquidity premium of 200 basis points and the pricing they were getting over the last 2 years is maybe not going to be there. Maybe the covenants will suffer because the private credit, we wrote research, has actually stronger covenants than the BSL market. So if that competition opens, we can see dilution of covenants, which is not great for creditors. But broadly speaking, lower rates should help the overall performance.
You mentioned the refinancing, and I actually talked to a number of sources who are very concerned that next year in 2025, 26, there's going to be a wall of refinancings of companies that locked in those low rates and now suddenly have to repay their debt at a much higher rate. How much of a risk is that? How worried are you about that looming wall?
Absolutely. And I said, the good thing is about that zero sort of rate cycle during the pandemic, 2020, 2021, is a lot of companies refinanced. The market was open for companies who traditionally would not even been able to access capital. So if you think about an average life of a loan, 3.5 to 5 years, yes, it's coming towards more 2025 and 2026 and 2024. So the later part of 2024, which is kind of the expectations when there is going to be rate hikes, our base case is roughly second half of the year, springtime, we'll see maybe up to 100 basis points lower rate. But that could actually help whoever the companies, if the companies can wait for that later part of next year and actually capitalize on the financing cycle of 2025.
We got to run. Anna Arsof, Global Head of Private Credit and Financial Institutions at Moody's Investor Service on Bloomberg.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.